This is Richard Flax at MoneyFarm with our regular monthly update. It's been a really interesting few weeks in financial markets. The conflict in the Middle East seems to have de-escalated, but the Straits of Hormuz aren't really open, and the oil price is still sitting close to $100 a barrel. At the same time, we've seen a pretty solid rebound in equities in April, and that's generally helped portfolios. So how should we think about this? We think there are a few points to make. The de-escalation is obviously positive, even if negotiations continue to drag on. But the oil price remains well above where it was at the end of February, and that's hitting households and businesses. We've already seen inflation readings in the US and Europe a bit higher than they were on the back of higher energy prices. And we think we'll see higher prices elsewhere the longer those higher energy costs persist. At the same time, the latest macro data hasn't been particularly weak. Retail sales in the US, for instance, held up pretty well in March, better than analysts had expected. And that suggests that overall US consumers haven't yet reined in their spending. The second point is around earnings. Earnings forecasts for this year across most markets have continued to rise over the past few weeks, despite the conflict. Analysts continue to expect double-digit earnings growth across most markets. The latest earnings releases seem to support what is a pretty optimistic assessment. In the US so far this quarter, the percentage of companies beating expectations has been higher than average. If we do see double-digit earnings growth in the US this quarter, and that's what we're expecting, it would mark the 6th consecutive quarter of double-digit growth, and that's something that's been underpinning equities. So there's this tension between the geopolitics, which has de-escalated, energy prices, which remain high, and corporate earnings, which look pretty resilient. In April, resilient earnings have won out and equities rallied. It's worth highlighting that we saw US tech lead the charge in April, after a lackluster few months. The combination of strong earnings growth and a de-rating in tech valuations has caught investors' attention, pushing concerns about a potential AI bubble to one side, at least for now. In terms of key questions, we've really had two. How long will energy prices stay high? And how big an impact will they have on the global economy and markets? In terms of energy prices, it looks like they'll be staying higher for longer, even if the conflict continues to de-escalate. That means we'll likely see inflation stay higher than central banks would like. We think it probably means fewer cuts rather than higher rates. But central bankers will be looking for signs that inflation is accelerating more broadly, and that could prompt them to act. In terms of equities, we think while we continue to see strong earnings growth, investors can look past the geopolitical noise, even if a lot of the expectations are focused on tech and energy. And overall, that's an environment where we think equities can hold up okay. Thanks for watching, and look forward to speaking with you again soon.